Okay. Hi, Jen. We're going to talk about conventional loans today. Good morning.
Yes, perfect.
So our audience really wants to know, what does it take to qualify for a conventional loan and what's the benefits of a conventional loan? Let's just start of like what it takes to qualify, I guess.
Okay, so we'll first start with the minimum down payment requirements. So a conventional loan, if you do a quick Google search, you're going to see the minimum down payment is 3%. However, to qualify for that 3% down, you can only make 700 in our region, $71,280 a year. So, you know, with the way home prices are in our region, if you're only making 71,000, it might be kind of difficult to qualify for that 3% down. But that's something that I look at initially. If you are over that income threshold, then the minimum down payment would be 5% down. Some other qualifiers, typically you're needing a 620 credit score. But when you have that 620 credit score with a conventional loan, you're going to get hit. Your interest rate is going to get hit. So sometimes it makes more sense then to go back into that FHA 3.5% down. But if you have excellent credit and you have that 5% down, conventional is always going to pencil out.
So what's the benefit of going conventional if you have the 5% and you have better credit?
Yeah, so you're going the monthly mortgage insurance is going to be cheaper on a conventional loan than it is on an FHA loan. So that's going to make your payment cheaper. You know, sometimes we see with government loans that the interest rate is a little bit lower than a conventional loan. But again, that monthly mortgage insurance is higher. And so as long as you have good credit and you can get into that, you know, good tier of an interest rate, then that's going to be the benefit, is that your monthly payment is likely to be less.
So is there a point where the mortgage insurance actually does drop off?
Yeah, so that was what I was going to say. The other benefit to having a conventional loan versus a government loan like an FHA, USDA, VA, is that once you reach that 20% threshold of having 20% equity in your home, so you're paying down your balance, right, as you're making your monthly payments, and hopefully, and what we've been seeing historically, is that your value is rising. So you're gaining that equity, that in between is your equity. So once you get to that 20% mark with a conventional loan, you can call your servicer who you're making your payments to and ask them what the steps are to remove that monthly mortgage insurance. With a government loan like FHA, the mortgage insurance is on your payment for the life of the loan. So until you either sell the home or refinance that loan into a conventional loan, you're going to have monthly mortgage insurance for the life of your loan. So that is a huge benefit with conventional too. If we see interest rates continue to rise and you're locked in a 30-year, you're going to want to keep that loan, right? So being able to remove that monthly mortgage insurance at that 20% threshold is an excellent benefit.
So are there actual loan limits to a conventional loan?
Yeah, so in every year, typically we see those loan limits increase. So right now we just saw the increase, and I have to look at my notes here, but I think it was 726,200 is what they increased for 2023. So a conventional loan, is substantially higher. Like in Marion County, Polk County, Oregon, FHA is in the $400,000 range. So that gives you a lot more buying power with a conventional loan, that you can go up to that $726,200 loan amount. So.
Yeah, I think it's so wonderful. Can you tell us what the benefits are for a person that is just getting into real estate? They're getting their primary residence and they're thinking, in the future, they would like to possibly add to their portfolio and get like an income property or turn their single family residence into, a rental unit to be able to purchase additional properties. How does that work with a conventional loan?
Right. So you could even start out with a government loan. Let's say your first home, you use a government loan, you use the FHA or a USDA loan, and you buy your first home. You live in there for a year and you have a child, and so you want to upsize. Then you get a conventional loan that only requires 5% down. And you can then turn your existing home into an investment property, which typically if you're buying an investment property, you're going to want to have 25% down. So, you know, to be able to then bump up your housing and only have a 5% down payment and turn one of your properties into a rental is huge. And you can continue that process. So,
How many
you know,
times can you continue that process?
so you can have up to 10 conventional loans. So with a government loan, you know, you can only have one. You can have one FHA loan at a time. You know, there are some instances where there are exceptions, but typically speaking, you can only have one government loan at a time. So with a conventional loan, to be able to continually each time only have to put 5% down, and you can build this investment property or portfolio is huge. And you're also getting the benefit with a conventional loan and purchasing a property as your primary residence, that you're getting a better interest rate. So if you go buy an investment property, you have to put 25% down, and the interest rate is significantly higher than it is if you're purchasing it as your primary residence. So you know, there's a multitude of benefits in doing this. And like I said, you can kind of wash and repeat and continue that, you know, 5% down. You live in the property for a year. When you sign your mortgage documents, you're telling them that your intention is to live in that property as your primary residence, and your intention is to live there for a year. So you
And
really
that's
do
for every single, that's for every single loan that you get.
yes, if you're stating that you're purchasing it as your primary residence. So, and the underwriters do a really good job of, you know, figuring out that, you know, whether or not this is going to be your primary residence. You know, they propose a lot of questions. You know, if you're, you know, you know, they'll look at your age and why are you upsizing? You know, they'll ask questions, and sometimes you'll have to do letters of explanation explaining how this is going to be your primary residence. If it's looks right, then, you know, there's not going to be those questions. But if it does, if it looks fishy, they're definitely going to ask, like, is this really going to be your primary residence? Yeah.
So definitely be honest, and just
always
make sure you live in there for a year. And then if you want to add properties to your portfolio, you're still able to just, you know, live there for 12 months each time.
Yeah. And it has to make sense, but yet there's definitely a way to do it. And I've seen people do it, and it's, you know, I'm like, oh my gosh, this is so amazing that these people can build this investment portfolio, you know, by doing this. It's kind of, I hate to call it house hacking, but in a way it is kind of, it's a hack.
So Jen, can you tell our audience, can you do this with multifamily properties as well, up to 4 units, or is it just for single family residents?
Yeah, it's initially, I would say if you want to get into the multifamily residence, maybe your initial purchase is a multifamily residence. It does kind of start to get, like I was saying before, the underwriters are going to start to ask questions, you know, like, hey, you have 4 kids and you're living in this 2-bedroom duplex. Like it doesn't pencil out, you know, so they're going to add, it has to make sense. It has to, like, realistically, are you going to be able to do this? So I would say initially, you know, your first purchase to be a duplex, 3 triplex, 4plex would make sense. Maybe even your second purchase. But as you get into like your 10th home and then you have 10 4plexes, that's probably not going to fly.
That's such great information, Jen. Well, if you guys want to reach out to us, we're definitely available to answer any questions that you may have. And I love when you said, you know, this is a great way to house hack.
Yes, it really is.
Yeah, because a lot of people don't really think that they could, you know, add to their portfolio. But if you only need 5% each time you try to purchase an additional property, then it might make sense for you and your family to be able to add, you know, rental units to your portfolio.
Exactly.
Yeah, Jen and I are from Salem, and our phone numbers are on the screen. So if you guys want to reach out to us, we're happy to help answer any questions and guide you guys through what it would take to be able to purchase, your first or your fifth or your 10th property.
That's right.
Any last words, Jen, before we
No,
head out?
I think this is great and love helping people get into either their first home or answer questions just about the lending process and what I can do to help.
Yeah, I know that I'm from Salem, and Salem has grown so much since, just like in the last 10 years, and
Right.
we're all connected in some way. So
Yeah.
yeah, feel free to reach out to us. We're definitely here to help.
Yes.
Bye for now. We'll see you guys on the next
Bye.